Welcome to the August edition of Market Matters. It's certainly been a little bit of a bumpy road more recently, and hopefully we can lend some insights as to what's going on and how we're positioned. Here's a quick look at our agenda for the day. Certainly some macro items we'll be touching on, a little bit more about stock and bond markets and just some things we're looking for on that end. Our asset class ranking and portfolio themes as well. And just as a point of note, I didn't put it in a slide here, but certainly just wanted to point out, just wanted to say a big thank you in advance to all our clients. We've been very patient with dealing with paperwork and custodial notifications around our recent merger with the Colony Group. So certainly appreciate everyone's patience on that. I know it's not necessarily an easy thing to keep track of, and our advisors and CSMs have been in constant contact with you all, but certainly happy that we got that transaction completed. And from here we move forward. So let's take a look at the current landscape from an economic and investment perspective. Just this, I thought this picture was apropos for this discussion. This is a picture of Tokyo at night. And for those that have been following along with 2 Minutes on a weekly basis, the last couple have revolved around what's going on in Asia and a lot of the tremors that have been causing some market turbulence out of Japan. I'll certainly touch more on that here, but I just thought this was a beautiful picture and also kind of appropriate for the current place and time. Quickly on the economic data, what was looking like a bit more of a more aggressive slowdown coming into July has actually turned into, again, kind of a little bit of a sideways trend for the U.S. economy. And you can see that kind of playing out here quite nicely where, this is our favorite picture of economic activity. It's the ISM services and manufacturing indexes. And recall that just for orientation, any number above 50 indicates expansion in that sector, and any number below 50 indicates contraction. So while the manufacturing sector has been bumping along in a slight contractionary environment, nothing too crazy on that front, a noticeable nice acceleration in the services sector in the month of July, I think really puts a renewed energy and effort into the fact that, or the idea that we're still in a kind of a slowdown period, not necessarily an economic crash or disruption, and that yes, there are some undercurrents in areas of the economy that are not doing so well, but there are also areas that are doing pretty well, which we'll try to outline some of that as we go along. So kind of a mixed picture here. Inflation coming down is certainly helpful to asset prices. You can see the evolution of CPI, which is both the headline inflation rate, that's the purple line, and the core inflation rate, which strips out food and energy. Then we've also decided to add in there the more volatile producer price index, which is just the essentially the wholesale prices that companies pay. And what you can see is here a pretty noticeable continued deceleration within inflation down to around this 3% level. Certainly we would like to see, and I think other investors, Fed in particular, would love to see the headline inflation rate go below 3, which it just ticked below last month, but we'll have to wait and see. But I guess the point of this showing this slide is that we had a bubble after COVID. We've come way off that number more recently, and now we're going to have to see how much lower below 3 we can get to really feel that inflation impulses are behind us. Because if that producer price index continues to accelerate, that may indicate that we've got more inflationary pressure on the horizon, and that would certainly be a bit of a troubling development within the inflation dynamics, because the bond market certainly is pricing in things now that inflation is behind us. So we'll have to just kind of wait and see. But for the time being, slowing inflation, continuing to decelerate is a good thing. Just a quick picture at the consumer balance sheet. Now this is a different way to look at this. There are a lot of different measures that would show the health of the consumer. This is just one of the positive ones that we found interesting over the last few weeks that I thought I'd share. This is the percent household net worth that debt comprises. So it just basically takes your assets divided by your liabilities and says, all right, what's that ratio? The lower, in this case, the better. So less debt per assets owned. And you can see here, according to this picture, the consumer balance sheet, household balance sheets haven't been this good since the 1970s. And you can clearly see, just a point of reference and maybe point in time, the leveraging that occurred from 2000 to 2007-8 timeframe, primarily in the form of mortgage interest, mortgage debt, or HELOCs, that really caused a massive spike in this ratio, has now collapsed down to a level that's very manageable for most households at the moment. So yes, the lower end of the consumer segment is not doing as well as maybe people had hoped it would. People that own assets, however, which is really, I think, what this comprises of in aggregate, are doing quite well from a ratio standpoint. So propensity to spend is driven by the amount of debt you can take on. And according to that metric, just one metric, of course, the household balance sheet is actually looking pretty decent, despite what's being mentioned in news reports. Another, I think, positive to the economy that certainly I think is not getting lost on many at the moment is corporate spending, and that's in the form of either whether it's on the AI build out or reshoring, has certainly inflected quite positively over the last couple of years, really ever since COVID disrupted supply chains. Has really forced companies to reevaluate what they decide to outsource overseas to building here in the United States. You can see last Market Matters, we showed you the spending on AI related activities out of the top 6 or 8 companies, and that was growing very rapidly. This is a different way to look at that, which is construction spending for factories on a 12-month rolling basis. And you can see here that the factory spend to build new property, plant, and equipment here in the U.S. has just skyrocketed more recently after languishing in a little bit of a soft upward trend. And this just speaks to the fact that companies are more likely now restoring supply chains. CapEx is being built out for the AI trade. And this is a very positive economic impulse that could be at the moment taking the place of soft consumer spending. So another, I think, positive. And then not positive or negative, but I figured I would just update this chart because I showed it last time, and this was when President Biden was still in the race. What's happened, of course, since then is he has dropped out of the race and nominated Kamala Harris as the Democratic frontrunner. And she's getting a lot of positive activity. You can see how these betting markets are now pricing the propensity of her to win versus Donald Trump. And you can see Donald Trump's betting average now has come way off from mid 60s, low 70s, down to about 50%. Kamala Harris is at 44. This is as of the 5th of August, so that might have changed a little bit since she announced her VP candidate, probably a little bit closer. But that notwithstanding, I figured I'd just share this to show you what the betting markets are suggesting the outcome of this race is. And again, now it's turned into what was once a month ago a very one-sided race, is now turned into a very close race yet again as Kamala Harris has entered the fray. And of course, not taking any view on one side versus the other, just that's where we stand at the moment. So looking at some big picture themes, we have updated this a little bit since last time. So I did want to point out some of the ones in the areas that we've noted. You see on the left-hand side there are the 2 newer quadrants that previously haven't existed. What's been going on more recently is interesting to note in that markets underneath the surface have been rotating quite a bit. This was, of course, maybe before the Asian financial crisis kicked off, but we did note a remarkable rise very quickly in small company stocks versus large company stocks, and that rotation was really quite powerful over the last couple of weeks. Various reasons for that, and a lot of things have been noted as to why, but certainly the trend looks maybe to some appearing to have changed, but I think this is really going to be more of an ephemeral rotation per se, because I think that all the forces that have aligned to allow large companies to best small companies in performance are still very much intact, meaning access to capital markets, margin profile, quality of management teams. These are all still, I think, very much in place for large cap to do a little bit better over a longer time frame than small cap. So we are, I would say, fading the small cap rotation a little bit. We don't really have much exposure there outside of our mid cap exposure, but still very much and firmly in the U.S. large cap camp. But certainly we'll be on the lookout for when we should be adjusting or modifying that. I would just point out or note here, this does appear to be something similar to what's going on in markets at the moment, meaning volatility coming out of Asia, something similar and akin to the Asian financial crisis that happened back in '98, that kicked off a slew of selling and volatility within bond markets, but also in stock markets, did lead to the collapse of long-term financial or capital management, which is the big hedge fund back then. And in this case, what happened was the Japanese central bank decided to raise their interest rate, their short-term Fed funds rate, if you will, more than the market expected. That raising of rates caused a strengthening of their currency relative to the US dollar, and that had a cascading effect in what they call the carry trade. So that's when you borrow or sell short Japanese yen to buy financial assets, and you do it on a leveraged basis. This is generally a trade reserved for institutional managers, hedge funds, pension funds to that degree. But when you talk about the amount of leverage they've put on this trade, you can easily see why the sell-off has been so visceral over a short amount of time. I would say, we likely aren't out of the woods completely as far as downside is concerned within financial markets. If we're using Asia financial crisis 1.0 as a guide here, it took a number of weeks for this to normalize. But then again, I could be wrong in that statement, because Japan and the Japanese stock market down peak to trough 15% in 2 days and 12% in 1 day actually tells you that maybe there was a lot of margin calls and forced selling that occurred over a very short 48-hour window, clearing the decks for maybe buyers to step back in. We'll have to see exactly how that's going to evolve. It's very hard to be precise on these things, but the magnitude and breadth of the selling pressure out of Asia indicates, at least to me, that we could be finding a bottom here, particularly in Japan, but also in US markets tangentially. Upper right hand, financial markets should not necessarily be too impacted by politics, although the UK example of Liz Truss introducing her budget that was very poorly received by markets does tell you that there is some influence there. So we will be keeping an eye on political developments here in the US and policies as they're being proposed. For our Atlanta market updates, we should have some thoughts from a guest speaker. I won't necessarily say who that is quite yet. I want to keep it a little bit of a surprise, but where they're going to give a review of political proposals and maybe some positioning recommendations ahead of the election in November. And then the big one, the Fed being on hold really doesn't mean they're all clear. Matter of fact, now they have a propensity to want to decrease rates, according to the Federal Reserve Chair, Jay Powell. They haven't cut rates yet. They're indicating they want to here in September. But again, this is all conjecture and Fed speak, and then nothing has really happened. So we have to follow what they're actually doing, not necessarily what they're saying, because if you are a data-dependent Federal Reserve now, then forward guidance, one of their policy tools, has less meaning. And I would also say that we are increasingly looking for ways to add some duration back to the portfolio now that rates have kind of had a little bit of a spasm here more recently. The slowing in manufacturing does indicate that rates could be headed lower gradually and over time. And so I think that's just one priority for the investment portfolio at the moment, is that we'd be looking to add more to rates here in the not too distant future and duration. Just a quick look at our asset class rankings. Only one real thing has changed over the last time we reviewed this last month, and that is kind of moving mid-cap back into a more neutral range from an overweighted, slightly overweighted positions relative to our primary benchmarks. So this is really, I think, just as a result of some of the movement in markets, that's really kind of how that's aligned. But at the same time, we still maintain our US large cap exposure. Don't expect to have much change to that at any time in the near future, because that continues to work pretty nicely for us. I would just say international companies, we would be looking for opportunities down the road to increase our international equity exposure. We're currently pretty happy with the exposure we have, which is very underweight global benchmark indexes. But getting back to a more neutral position over time, I think makes some sense, particularly now that we've had this volatility spasm out of Japan that may have even made those opportunities internationally a bit more inexpensive and attractive relative to US companies. But we're still holding what we've got at the moment. Bonds, I just mentioned, we still have this inclination to want to look to add selectively to our duration position. So across portfolios, we carry about 2/3 of the average duration of the bond index. Maybe we're looking to get a little bit closer to that index level duration, but that's going to be episodic. It's going to be position by position, and we'll just see what opportunities crop up that allow us to do that. And then finally, higher volatility in bond markets and stock markets and the option market for that matter does and should translate into better returns for alternative strategies, whether they be liquid or illiquid. For example, long short equity funds, hedge funds in this environment should be able to generate slightly better returns than previous, because now securities are moving around a lot. So we still think there's a lot of work to do on that front. And maybe our more recent fund launches speak to some of that initiative. So just touching again back on some of what we're seeing on the US side and equities. This is the picture I think we showed last week. All data is as of June 30, which is the last time it was updated, but I can give you a quick update as to where we sit today. Even with the sell-off we've had more recently, about 5% in the S&P peak to trough, the forward-looking PE ratio still stands at about 20 times versus 21 as when it was back in June. So still a little more elevated than we would like to see it. But there are reasons to pay up in valuation that maybe make that level less scary than it really seems, particularly relative to historical averages that a lot of other investment groups talk about, which is this 16 to 17 times earnings on the PE ratio. There are reasons to maybe discount that a little bit. So we do recognize valuation's a little stretched. However, the good news is, as I keep pointing out in some of the 2 minutes decks, is that earnings in the S&P continue to surprise to the upside. And you can see that here in this chart, which shows you a by sector growth rate year on year in S&P earnings. This data is through August 1st. So this number has actually gotten a little bit better. But what you can see is coming into Q2, at the end of Q2, sorry, before companies started reporting, the market expected the S&P to have earnings growth of around 8.9%. What's actually occurred since that time, however, is the S&P earnings have come in much better than that at 11.5, I think closer to 12 now. And if the market can continue to surprise to the upside, then really there's not a substantial risk that there would be some fundamental issue that investors would be anchoring to. So the Japanese situation was not a fundamental factor driving markets. It was more of a macro factor. Now that macro factor has subsided, selling pressure has subsided, you can see as over the last couple of days, well, probably 3 days, the S&P is now nicely in an upward trend. That's just getting us back to potentially where we were a week and a half ago. But this is still, I think a really positive signal for future upside, getting certainly back to where we were before the sell-off. This is one of those reasons I was saying we might want to discount historical averages on the PE ratio and maybe take other factors into account over time. And that is by various metrics, whether it's net income margin or free cash flow as a percent of sales, financial metrics for US stocks in the S&P have been improving for the better part of the last 30 years. So this is why when we look at a PE ratio of 20 times forward earnings, let me just go back to that slide. Looking at this right here, some would say, well, we're well above the 30-year average of 16.7 on a forward-looking basis. And I say, well, yeah, we probably should be, however, because the profit margin and ability for companies to generate cash has, over the last 30 years, improved really meaningfully. So if we get more cash out of the same share, more net income out of the same share of S&P companies, then theoretically the valuation should be rising along with that. That's just one reason that I'm not so concerned about the valuation at the moment in the S&P. I think the last week and a half, just as a useful reminder, and thank you to folks at the Colony Group for this information. But it's a useful reminder that, the market is supposed to be volatile. As Warren Buffett likes to say, volatility is the price you pay for being an equity investor. And I think a year or the last couple of weeks is certainly on display. And this just shows you a few things. This chart goes back to 1980, shows you the black dot is the intra-year decline through that year. And the full year return is in the blue bar. So a year like 2020 You can see there the market was down 34 at its trough in March, April timeframe of 2020, but ended the year up 18. That's a massive swing of what is that, 52% in that 12-month period, with the average drawdown being 14% in any given year. And just some other stats to reinforce that. In any given year, a 5% drawdown should occur roughly 3 times in every calendar year. A drawdown of 10% or greater should occur about once a year. And so we've gotten, I think, a 5% drawdown in August, and that's on the back of some weakness coming into July. So I think peak to trough, we're off, close to 8 or 9% peak to trough. And that's just garden variety. So there's nothing really too much to be concerned about at the moment. When you get to those 20% levels, that actually starts to perk my ears up and say, right, maybe there's some structural or fundamental reason that we're down this much, but anything short of that is just really noise, I guess, is the point I wanted to make to this. Another kind of negative that I hear a lot of people talking about is, U.S. companies are dominating the globe, and every time that's happened in the past, there's been a kind of give back. And certainly that's a fair observation. What this chart shows you is the total world stock index, the MSCI All Country World Index, and the percent of that index comprised by these regions. Now, you may be totaling these up if you're a math-oriented person like I am and say these don't sum to 100. You are correct, because there are regions like Australia or Singapore that are not included in these lines. So maybe I'm overthinking this, but notwithstanding, it is notable that the U.S. is at such a large percentage and growing percentage of capital concentration within global indexes. But of course, that was not the case way back in '87, where you can see Japan dominated the MSCI Total World Index before having a real estate collapse. And these little squiggles over time, I think, make some sense. And the U.S. dominating makes a ton of sense because, we are home to the champions of not only software as a service and AI, but also other segments like medicine, healthcare, that really, I think, speak to the fact that U.S. Should comprise a larger percentage of the All Country World Index, because there's just not a lot going on in some of these other countries. Europe and Japan in particular have been in stagnation for many, many decades now, whereas the U.S. economy is not. And so it's just a reflection of economic vibrance, in my opinion, more than anything else, and nothing to be too concerned about. What is, kind of important to note is that we did get, again, another reason why I think the more recent episode is going to be a bit more episodic in nature than anything structural or leading to some sort of trapdoor moment here in the future, is for 2 reasons on this chart. One is this is a picture of the volatility index, the VIX index. You've heard me talk about this previously, going back, and really for reference, the VIX index is a proxy for volatility in the S&P 500 options market, which is commonly referred to as the fear index. As this index is rising, it just means that more and more investors are buying put options on the S&P index, and that's why it's called the fear index, because people are looking for ways to protect their portfolio, generally at the worst time. So it rises very quickly. Along with that, and what's important to keep in mind too is, this is a picture of the high yield bond market, the orange line. And generally, if it's a more systematic issue that is probably worth paying attention to, the high yield index spreads would be widening, meaning default rates in the future being priced as higher and higher potentially, would be rising along with this VIX index. But you'll notice, like it did in COVID, and in some way, in some small way back in 15, 16, this is actually the shale boom and bust, where there's a lot of energy companies. But unlike COVID, while the volatility index did get to a level we haven't seen since COVID, and then before that, the financial crisis, it's come right back off where it peaked at when it opened on Monday, which was 55, which was a pretty high reading. Came right down, closed the day below 50. I think yesterday it closed below 40, and then I think we're in the 30s right now, likely going to be closing below 30 by the end of the day today. And the other thing to note here, though, is that high yield bonds have not spiked, the spread has not spiked along with this, which means that the high yield bond market is not pricing in a higher probability of recession than it was the prior day. And so in that way, we think this is going to be a fleeting kind of moment in time and nothing too concerned, or nothing to get too concerning about. I would just point out that this volatility index spiking or moving higher is actually really good for option-based strategies. So for those of you that are aware, we do run an option strategy. These types of conditions are really attractive when the volatility index is rising, because it means that people are paying us more in premiums. But that's about all I can say on this podcast. But this is a good environment for option-based strategies if you're an option seller. And then just to point out here, bonds in a very short period of time have gone from boring to a focal point, meaning that the yield curve has been moving around quite a bit, and you can tell that by some of these ratios that we've looked at before. And the two ratios are the 10-year minus the 2-year bond yield spread on the U.S. Treasury. So just a difference in what a 10-year yield is versus a 2-year yield. If it's negative, that means the 2-year yield is higher in yield than the 10-year. And the same thing for the 10-year 3-month. This is actually really more following proxy of the Fed funds rate. And notice, interestingly, that this is the 10-year 2-year, 10-year 3-month are actually diverging. I don't quite know what to make of that quite at the moment, other than to say the market is maybe discounting what the Fed is saying versus what they're actually being pressured to do, which is cut rates. So that's the way I kind of read this. But I think, as I've said it in the past, the fact that the yield curve is what they call inverted, or meaning that the 10-year is lower in yield than the 2-year, isn't necessarily problematic, but where it can be a little problematic is when you finally breach into a positive yield curve situation where 10-year is now yielding more than 2-year. And that generally sets in motion, recessionary conditions. And I guess my point in this to say is we're getting close in the 10-year, 2-year, but we still aren't quite there yet. So it's nothing really to get too concerned about until we firmly move into this positive territory. And it's really at that point, it's the speed that it goes up that's more important than anything. That generally comes when the Fed starts cutting rates. So their bonds are, kind of a focal point again to keep an eye on. And let's just summarize with some key takeaways. I did update a lot of these comments, so this is, I would say, newer content. But, sleepy summer, it's turned into a more active period for markets. It always kind of seems that that's the case, right? Where, a lot of points in time historically of kind of where negative market activity has occurred has coincided with these August, September, October timeframes for whatever reason. I don't want to put a finger on it for lack of being completely wrong. But it's turned into a more active period for markets. They're finally experiencing a meaningful drawdown. This is actually a really positive outlook because that's clearing the deck, or the analogy I like to use with some clients is the forest fire is kind of burning off the kindling that's been dropping from the trees for a number of years now. We'd like to see further downside to get a little more excited about current prices, but that doesn't have to happen to get back to maybe where we were before this sell-off, because I think the earnings momentum, as we talked about, is still very much in place. It's still a great time to be managing risk. I mean, we're not too far off all-time highs, and this complacency certainly is there in some parts of the market. We are trying to be diligent about managing some of those single stock risks, and even doing some portfolio adjustments. But it's around the edges at the moment. If there are concentrated positions, this is a great time to deal with those. We've modified this a little bit, where bonds are now providing us a little bit higher yield than they have in some time, and some more stability. So our priorities are still remain bonds for liquidity with as a primary function, and income as a secondary option. As you may recall, we still have a fairly short duration in our portfolio, which means that if interest rates fluctuate a lot, our portfolio isn't going to move around terribly much. We're generating most of the return in income, and we want to be able to use that capital to rebalance portfolios or action on really attractive ideas if and when those come up, because they are pretty fleeting. We do still see a lot of opportunity on the structured credit side, so mortgage-backed securities continue to be a great opportunity set. And then conditions, I would just say, are improving now that we've finally got some volatility back in the market for alternative strategies. Higher volatility, rising credit spreads, correlation that's starting to come down a little bit between stocks and asset classes, all bode well for active, either long short strategies, macro strategies, private credit strategies. These are all, I would say, attractive conditions for alternatives at the moment, both the liquid side and the illiquid side. And with that, I think that's all the comments I had for today. Hopefully you found this useful and, got our thoughts. I do think, this was well timed in that, we were able to touch on some more recent market volatility, which again, just summarizes, in our opinion, a bit fleeting, but still in the moment, it's not great to have to deal with. If you do have any follow-ups, feel free to reach out to our advisors. Again, thank you for your patience through this transition phase for Gratus. And we look forward to speaking to you again sometime here in the very near future. Take care, everybody.